Recording is starting. There we go. First one. So spot on 6:30. So 7:15. All right. So again, welcome everyone. I think were you here last week?
No, I wasn't.
No, I was just I thought you were a new face. So everything I've just been saying, you'll catch up with. There's a podcast you'll be able to hear last week. The two things that we talked about were the Land and Business Sale and Conveyancing Act, which is the act that affects people in real estate, but selling people, right? You conveyancers, you have your act. Anyone who sells real estate, the most important act for them is the Land and Business Sale and Conveyancing Act. And we looked at there are only 3 sections in that act that deal with businesses, and we talked about those 3 sections. Section 4 that defines what a business is. Section 5 that defines what the cooling off is for a small business, and Section 8 that talks about the vendor's disclosure statement, the Form 2, that you've all now just got another copy of. All right, so that deals with going over what we did last week. Tonight, we're going to deal with what I think is the most important thing, because that's the thing that I make money out of, which is the contract. When we make a sale, hopefully someone's going to buy the business, so we prepare a contract, and that's the contract that then comes through to you to have to settle, right? So there's 2, in South Australia, there's 2 main contracts that are used. If you are an agent, it will be this one that's just been handed round, the contract by the Real Estate Institute of South Australia. Most agents are members of the Real Estate Institute, not all, it's not compulsory, but 95% of agents are members, if for no other reason. They're members so that they can get these documents online, right? Because it makes life so much easier when you've got to sell something, if there's a contract available online and all you've got to do is fill in the gaps, right? Much better to, rather than reinventing the wheel, someone else has made a wheel. All you've got to do is fill the spaces in. So that's the one that almost all agents use. So any of you working in the industry where someone sells a business and needs a conveyancer to do the settlement, that's the document that you will get sent by the agents to settle. So we'll talk about that. But the other thing that happens is that some people do deals privately. They don't use an agent, usually because it's a small business, very small business, right? And the fees that they will have to pay the agent, they think, it's going to be too expensive. But, there are lots and lots of businesses that get sold for less than $50,000. You think about lawn mowing rounds. You think about dog washing businesses. You drive around and you see these mobile dog washers. Lots of those little mobile businesses that operate either from people's homes or they come to you and do jobs, cleaning jobs, window cleaning, all sorts of businesses that people have that they don't run from their car or they don't have a shop. So when they come to sell them, there's not a lot of money, right? Now, because selling businesses is difficult, and I talked to you last week about the number of people that are involved selling businesses, because most people in real estate think that selling businesses is the hardest thing that there is, because there's nothing you can see for goodwill. It's the largest amount of money is paid for the goodwill of the business, which is air. You can't see goodwill. It's reputation. It's history. It's what people think about the business. It's the record of being able to have that name. So for a lot of real estate salespeople think that that's very, very difficult, right? So they don't do it. So there's only a very small number of business brokers that do sell businesses. And because there's only a small number and our skills are quite high, our fees are quite high. It's quite expensive to use a business broker, right? Some of you, when you get out there and start working in conveyancing offices, will see contracts from brokers come into your offices for settlement. And you will look and you will see somewhere, particularly if you are acting for the vendor, you will see what the agent is earning for selling. Most of you would be aware, how many people in this room have bought or sold a house? Some of you, okay? Do you remember, did you buy or sell?
Buy.
Buy. So have you sold?
Yeah, buys.
Both. Do you remember what the agent charged you for selling a house?
No.
No. So what did you say?
I think it's around 12%.
Oh, well, they would wish they get. It's about somewhere between 1 and 2% is all they charge to sell a house. Whereas business brokers charge 7 or 8%, right? And we have a minimum fee. If I sell a business for $100,000, I don't get 7,000. I get 25,000. That's our minimum fee. Right? So some of you will see some of these contracts come across your desk and think, good Lord, they're earning a lot of money. But what you don't understand is to get to the stage where that document is done may have taken a year's work. The average business takes somewhere between 6 and 12 months to sell because there's not a lot of people who want to buy a business. When you go to the bank don't want necessarily to lend money because it's all on goodwill. So it's difficult. Selling businesses is difficult. So because of that, we charge high fees, and because of that, a lot of small businesses don't use brokers. They do it privately. If you go and look on Gumtree, you go and look on Facebook, you will see people who've got, like Jim's mowing rounds that they want to sell for $15,000, $20,000 for small businesses. Now, if I'm going to charge them 25 and they're only going to get 20, you can understand they're not going to use me. So a lot of those businesses get sold privately.
So the conveyancer will do the contract.
Right. So when they sell it privately, then they say, well, now what do we do? And somebody says to them, well, go and find a conveyancer. The two of you go to the conveyancer and tell them. And so they'll come to you and say, I'm Bill, he's Fred. Right, I've got a Jim's mowing yard. He's agreed to buy it from me for $20,000. Will you please draw up a contract? Right. So that is why the Australian Institute of Conveyancers have their own contract. And when we look at this one, which we'll also do tonight, you'll see there's no talk about an agent. There's no mention of an agent because these ones are traditionally where there is no agent involved. Okay, so that's... Yes. Yes. First. First.
All right, Julie, you go first. Sorry, you go.
What was your question?
Just in relation to that, whether two people come to you,
Yes.
I was confused about something you said last week. You said where two people come to your office and say, we've agreed to a deal, and we want you to draw up a contract, and you're allowed to do that, and you're allowed to charge them a fee. You seem to be suggesting that you would frequently act for both parties, but we...
well, no, not necessarily. I'm saying not necessarily.
That's what I was going to say.
Yeah, because we looked in
You-
taking instructions in relation to a transaction which you marked the assignment for,
Yes.
that even where there's no pre-existing conflict of interest, and even where they've signed the waiver, they allow you to act for both, that it's rarely advisable to act for both parties.
Correct.
Because there's always a big potential for a conflict of interest, and you would be covered by indemnity insurance.
That's completely correct, and that is these days. I mean, okay, it used to be that in private transactions they'd go to one conveyancer, and the conveyancer would do the deal. They'd write up the contract and act for both sides, and 99 times out of 100. There'd be no problem. It's a very low fee, simple transaction. However, people being people, conflicts do occur. Yeah. So yes, if you want to talk about what is best practice, even in a private sale, even where the sale is only for $10,000, $15,000, $20,000, it is better if each side has their own conveyancer, right? Yeah. Now, they may come to you and you may prepare the contract,
but then
right? Then you will act for one and you'll send the other one off to another conveyancer to act for them, right?
And even in a private sale, does the buyer beware principle applies that we would have, I guess, in our letter of retainer, a clause for the sale of business saying, we're not valuers, we take no responsibility whether or not you've agreed to a fair market value. Yep. It's your responsibility to check that out with the business advisor.
You should say that, yes. I don't know whether your individual letters of appointment would say that, but there should be something along the lines that you have agreed a price and you have come to us purely to prepare a contract.
So if later on one of them thinks they got done, we bear no responsibility.
That's not your issue. That's for them to sort out. The one thing, and that's why we did talk about it last week, the big thing that so many of those private ones will be small. So what's the thing you're going to need to make sure that they do?
Signing out.
Get a Form 2. You're going to need to tell the vendor, the Act doesn't say that this Form 2 only applies if there's an agent. Right? This Form 2 applies regardless. If the sale is under $300,000, the vendor of the business must get a Form 2 done and must give that to the purchaser.
What are the accountant's responsibilities? Does the vendor's accountant who prepares Form 2 have a responsibility to make sure the vendor's getting a good price?
No.
And if the purchaser has an accountant, they don't have any
responsibility?
responsibility?
The vendor may ask their accountant, do you think this is a fair price? But the reality is, anybody in this room an accountant?
Yeah.
Good. No? Good. All right, because I mean... now I can say what I'm going to say. Oh, even that's on record. Right? Accountants do have a tendency to think they know all things about everything, right? They do think that they are little mini gods. But the truth is, if you really ask an accountant, they're not trained valuers. They're not trained in the knowledge of what is a business value. So a vendor may say to them, look, this is my business, you do the figures, what do you think my business is worth, what should I ask for it? And they may give them a broad outline, but really they're not qualified, right? And it's the end of the day, it's the vendor's business. The vendor's the one. So there's no responsibility on an accountant.
Advertises that they have expanded services and they give business advice.
Oh, yeah, business advice is one thing about what to do, how to run your staff, make sure the correct wages are paid. That's business advice and business counselling, but it is not valuing. But without going into it too far, there are accounting firms who think that they are valuers, right? I know that. We come across them, right? They argue with us about what is the value of that business. And my simple answer is, well, how many businesses have you sold? And they say, well, we've never sold any. End of discussion, right? How can you tell me what a business is worth if you've never sold a business?
To do that, though, are they?
Sorry?
They're not qualified to be. You've got to value that.
They're not, in reality, the qualifications they get. They understand figures. They are experienced with doing figures and understanding all of that. But they don't actually study. In the course to become an accountant, you do not study the valuation of a business. Whereas to become a business broker, that is a large part of what we do, is study how to value a business based on how other businesses sold. You have to analyse other businesses that have sold to be able to say, this one did that and got that, and this one did that and got that. So using that, you can now say that this one, doing this, will get this, right? So it takes a little bit of working out. But anyway, we're digressing, we're going offline. So all of that is why there are two contracts. And all of that is why tonight, we will look at the two contracts. They are both very, very good contracts. They are very, very similar. In fact, really, the truth is, once they are laid out slightly differently, just the way they're set out is slightly different, with the exception of the fact that in the Real Estate Institute one, it talks about what the agent does and this and that, and the other one doesn't mention the agent, because in a private sale there's probably no agent. But all the things that are covered in one are covered in the other. So we'll talk about what are the things, as a conveyancer, if you are asked to draw up a contract, what are the things you have to look for? What are the questions you would need to ask? What are the things you need to make sure that you have covered so that the sale covers everything that needs to be covered? Okay? Make sense? All right. Just before I start that, let's quickly tick off the register. Nashiket Atalia.
Yep.
Oh, that's you. And you're here this week. Yes, you are. Was I close, by the way?
Oh, that's very
Okay. Wissam Farid. Yes, you're here. Yes, you were here too last week. Jane Humphrey? No, wasn't here last week. Jane didn't like me. Martha, I know you're here, Martha. No, she's been my helper. That was very, very good. Prami, I know you're here. There you are, yes? And I have got it. I just haven't got round to it because it's been a short week for me because I was away, but I'll fix it this week and I'll get back to you. Michael Coot.
Yes.
Michael, you're here. I see someone has written Michael underneath that. That's obviously you prefer Michael.
Yes.
Emma, I now know you're here. So all those little blanks, now we've got a ticket. Bowley, yes, there you are, the smiling bow. Julie is here. We know Julie's here. Despina is here. Girish is here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Got everybody. Right, good. And anyone who's listening to the podcast, I haven't marked you off because you're not here. Okay. So that deals with that. That deals with that. Put that there. Right. So, I'm going to start with the one I gave you first, the Real Estate Institute one, for 2 reasons. Okay? For a lot of you, you probably will see this one more than you will see any other one. If you are, when you finish this, when you actually go and work in conveyancing, you will probably see more of this than you will of the other one. And also, being quite honest, I am more familiar. This one is my bread and butter. I work with this one every day, so I do tend to know it inside out and back to front, and so I can make sure I go through and cover everything that's in it with you. The second one, which we will also talk about, Bill's given me 2. One is used... what is that? That's...
The other one's the vending statement.
No. One is the Australian Institute of Conveyancers business contract where there is no land, just selling a business. There is also, and we won't really go through it much, but I'll give it to you at the end, but you'll, again, like the other thing, you'll rarely see it. It's the Australian Institute of Conveyancers one where there is land, right? So that it's slightly different to the first one. But we won't go through that tonight, but I'll give it to you at the end of the night. All right. So, have you guys looked at the contract for the sale of land? Yeah. You have? Okay, so then this is a very similar document. You'll see there's a lot of similarities. It's laid out in a very similar way with all of the details that matter in the first few pages, and then it deals with the terms and conditions. So if from the point of view of somebody filling it in, all the bits that you have to fill in are up at the front, right? The first few pages are where you fill in all the missing bits till you get down to about page, and the one I've given you, what page is it where it starts? Goes right the way through to page 20. Out of 28 pages, this particular document. So up to page 19 is where we're filling in the bits, and then starting at page 20 through to the end is the terms, the rules, what happens. That's what spells it out. So just thinking about that for a minute, this is a 28-page document. Now, you guys, I'm assuming you are aware, I'm sure somebody has spoken to you, that what you are learning and what you do is reasonably unique in Australia. Right? Robert Torrens, okay? They talk to you about Robert Torrens, and what's the title called? A Torrens title. Why is it called a Torrens title? Because a man 150 years ago called Robert Torrens invented the system of titles that we use in South Australia that is very different to what it used to be before that. Before that, we used to have the English system. Right? Has anyone talked to you about this? Do you understand how that all worked?
Yeah, we talked about that.
You have talked?
Yeah.
Right, okay. Vaguely. All right. 5-minute history lesson. 5-minute history lesson. In England, if you wanted to... go back 1 second. In England, all the land in England was owned by the king, right? The king owned everything. If you wanted to buy a piece of land to build a house, you basically had to have it sold to you by the king. And you got a deed. A deed sold to you started off that said you were now granted that piece of land. This piece of land here belongs to you. And that was your title that said you owned it. Now, it's no longer the king's, it was yours. Okay, so you have that. And eventually you decide you want to sell it. You want to sell it, Michael, you want to sell it to Julie. Okay? So Julie says, well, prove to me, Michael, that you actually own this piece of land. You say, yes, here it is. Here's the document that I've got from the king that said he sold it to me. So you can see I'm the owner. So Julie says, right, I'll buy it. So you agree a price. And a lawyer draws up another document which transfers the land from Michael to Julie. But Julie doesn't have all the money. So she's got to go and borrow some. So you go to the bank and they say, well, show us your proof. And you say, well, there you are. There's Michael's deed. And here's my deed that he sold it to me. But I've got to borrow money from you to pay him. So they say, right. So we'll give you a mortgage to lend you that money. Eventually, Julie, you pay that mortgage off back to the bank. So you want some evidence from the bank to prove that you no longer owe them money. So they give you another document which says that mortgage has now been paid off. So now you own that no money. And eventually you decide to sell it, right? And you sell it to Emma. She decides she wants to buy that block of land. And she says, well, now, hang on. How do I know you own that, Julie? So you say, well, here's all my documents. The original one from Michael, to me, to the bank, back from the bank, there's my chain of title, right? So Julie says, okay, now I believe that you own it. So now, Julie, you can now sell it to Emma. So now it comes to here. Now the document's drawn up. You get the picture? A chain of documents. Somewhere down the line, Emma moves house and loses Michael's original deed, right? And then wants to sell it. How can she prove she legally owns it? It was an enormous problem, right? And therefore lawyers were very, very much involved, because if Emma wanted to sell it to Bo would get a lawyer in to say, I want you to check, make sure none of these documents are forged. Are they really? Does she really own it? So it was a long, complicated and expensive situation. Right down here in South Australia, hundreds of years later, this guy, Robert Torrens, was working for the government, and he was involved in checking titles, right, in the chain, worked for a legal firm. They used to have to check if someone was going to sell to make sure all the documents were right. And one night he had a brainwave. And he said, this is so complicated. It takes so long. You have to have so many documents. It's ridiculous. What if, for every piece of real estate in South Australia, there was a single title for that piece of real estate? And on the title, it had a diagram which showed the land and showed where it was, the street, how many metres it was from the corner, so that you could identify exactly that that title was for this block of land here. Okay? And then, if Michael wanted to sell it to Julie, all Julie had to do was come into here, and here it was in the government office, and she could see it. And she could see it had Michael's name on it. And Michael showed her his driver's licence and said, there, that's me. And it's got his picture on, so there's no doubt that he's the person who owns it and he's who he says he is. So she buys it. No new documents as such, other than a little line is put here that says, up here it says Michael, now it says Michael sold it to Julie. Still the same document, this original document stays here in this one place. So Julie sells it, just another little mark on the document. Emma sells it, another little mark on the... So what he did was he created a system of ownership that simplified everything. right? Made it extremely simple. Have any of you been to the Lands Titles Office?
No.
Have you don't know? Well, as conveyancers or future conveyancers, you should go and have a look. That's where they all are. The title of every property in South Australia is there in one place. And it's public information. So even if it's not your house, you can ask to see the title of anybody's property. And it's there. And not only can you see the title, but on the title, you'll see the little marks that tell you who now owns it and what they paid for it. It's public information. So anybody can go and search that. So because it became so simple, Robert Torrens said, we don't need lawyers now because there's no checking that needs to be done. The government is guaranteeing this document. Right? It's a simple system. Okay? So if Michael wants to sell to Julie, he gets a real estate agent who negotiates the sale, and the real estate agent just draws up a very simple contract, says Michael's going to sell, Julie's going to buy, the agreed price is $50,000, and they both sign it. That's a contract, right? Then that contract goes to a conveyancer, and the conveyancer prepares the document that goes to the titles office to say, change the title. It was Michael, it's now Julie, please change the title. Right? Now the government gets its share because you pay stamp duty on that, and then they charge you also for registering on the title, so the government gets its share. But overall, the system is very, very simple. And the Torrens title system swept Australia, and everybody around Australia said, wow, this is brilliant, we're going to adopt it. This guy became Sir Robert Torrens, and they named a river after him, right? The Torrens River. We have Torrensville. We have Torrens Road. He gets a lot of publicity, this guy, all because he invented a system that not only went across Australia, but now in the UK and in most other English-speaking countries in the world, they use a version of the Torrens title system to record ownership of property. The big thing that happened in South Australia that didn't happen elsewhere was that Robert Torrens created conveyancers. He said, it's easy, we don't need to spend huge amounts of money on lawyers to do this. I've made it simple. We'll create a special group of people called conveyancers who can do that. And that's what happens in South Australia. But what happens if you go interstate? It's done through lawyers. Now, if you own a house in Sydney and you sell that house in Sydney, the agent cannot write up the contract. The lawyer writes up the contract. In fact, two lawyers write up the contract. One lawyer for the purchaser, one lawyer for the seller. Each one draws up a contract. They speak between themselves, and the agent gets to the point where Julie says to Michael, yes, I'll pay you $50,000 for your block of land, and I'll settle it on the 1st of October, and I don't need to borrow any money from the bank. So the agent writes down, that's the deal, and sends that to Michael's solicitor and sends it to your solicitor. So your solicitor, Michael, draws up a contract, a legal contract, that says Michael sells to Julie for $50,000, settlement on the 2nd of October. And he charges you $5,000 for that, by the way. And Julie, your solicitor, does exactly the same thing, and he'll charge you $5,000 for doing that. And then you read it, Michael, you make sure you're happy with it, and you sign it. Julie, your solicitor says, read this, you're happy with it, and you sign it. Then the two solicitors send it to the other one. Now, sometimes if you watch any of these renovation shows and things, you will hear the expression about exchange. So settlement doesn't happen until the contracts have been exchanged. That is exactly what happens. Your solicitor and your solicitor literally exchange the contracts. Okay? So now you're holding Julie's contract with her signature on it. She's holding your contract with your signature. So now you both go and sign each one. So we've gone from no contracts, we've now got two contracts, each one exactly the same as the other, and each one signed by both of you, and then settlement occurs. Okay?
That seems so complicated.
Doesn't it? And who's making all the money?
Lawyers.
Lawyers are making a fortune. So that is why the lawyers hate the conveyancing system that South Australia has. That is why as conveyancers, you will find years and years and years that you are practicing, you will very, very rarely do a settlement with a solicitor. Every now and then you'll find somebody who might have moved to Adelaide from Melbourne or Sydney and isn't used to our system and gets a solicitor involved. But you'll do hundreds and hundreds and hundreds of settlements where the person on the other side will be, just like you, a conveyancer.
But there's a lot of solicitors that do conveyancing.
Well, they've been forced to. What they now do is they employ conveyancers. Right? But the only way they could get into it was to... nobody was going to pay them $5,000 to draw up a contract when me as an agent does it for nothing. Right? So therefore, the only way the legal firms have got involved in settlements is that now some, not all, some legal firms have actually employed conveyancers and they have a conveyancing department within the legal firm. Right? And so that's where lawyers get involved. Just watching
Can I just clarify something?
Yes?
I had thought we were told earlier that most conveyancing business in Australia is done by lawyers, but but they are conveyancers in other states.
Okay, now, there never used to be. Right? It was only in the last 10 years New South Wales has allowed conveyancers to come into New South Wales. So there are conveyancers in New South Wales. They are called, in Western Australia, they are called settlements officers, right? They are the same sort of thing. But in New South Wales, and I know this for a fact because I deal a lot with agents in New South Wales, the public are not educated towards conveyancers, right? The public are told by their lawyers, oh, you can't use it. No, they don't know what they're doing. You need to use a lawyer, right? So it's very difficult for conveyancers. Some of the biggest conveyancing firms in New South Wales came out of South Australia. They opened New South Wales offices because they knew what they were doing. And they went up there, and there's several South Australian companies who have offices in conveyancing in New South Wales, because they do not understand what they're about, right? But even then, it's hard work, because the lawyers work against them. The lawyers don't encourage their clients to use them. Whereas here, it's so established in South Australia, people just don't think twice about using a conveyancer.
So only in New South Wales
and
WA, people are allowed, conveyancers are allowed to sell...
They're definitely not allowed in Queensland, and I'm not 100% certain about Victoria. They may or may not be allowed in Victoria. They are definitely not allowed in Queensland, and they are allowed in WA, and they are now allowed in New South Wales. Anyway, yeah.
Can I ask a question?
Of course you can.
WA and New South Wales have conveyancers. What's their legislation?
They have their own acts.
They do have their own.
Oh yeah. Each state, the act that we looked at last week, the Land and Business Sale and Conveyance Act, each state has its own version of that act, right? And there must even probably there'd be some sort of conveyancing act in those places as well that regulates what you guys can do in those states.
So Brian, just I'm going off track here, but if you are registered here as a conveyancer and you want to go into state and work as a conveyancer, then can you do that, or do you have to be registered in that state?
I think you have to be registered, but I think if you passed this course that you do, getting registered anywhere else is very simple. Everybody acknowledges that this is the number one course.
Oh, that's
right? Because what do you guys do? 3 years? 3 years or 4 years?
3.
2 years.
I think it's...
No, it's
Well, technically, full-time, it's 18 months.
For full-time, 18 months, part-time,
Really
3 years. Okay, it's still longer than I believe it is to get to anywhere else. So this is sort of considered the number one course. So if you've got this, when you finish this one, you would be able to, if you moved into state, get a registration. All right. Background, history, understanding of who Robert Torrens was, and why what he did was important, right? And why it's called the Torrens title system and everything else. So it just makes life easier. So this is the document, a business sale contract, which we're talking about. And as you can see in the top corner, it's got REI, SA. It's done. It's their document. So the front page, you've got the full details of the vendor, the full name. Now, again, when you're dealing with land, how do you know who the owner is? How do you know who's the owner of a block of land? You look at the title. When it comes to a business, how do you know who's the owner of the business?
business with
What are you checking at ASIC though? How do you find it? What name?
Don't you have a registration of business?
You can have a registration of a business name, but that doesn't tell you who the owner of the business is.
Oh.
So finding out the number one job in a business is who is the owner. Now, if there is a lease, a big clue will be what name is the lease in, right? If that fails, the other answer is to ring the accountant of the business. He will tell you what is the correct legal name. Yeah. Most businesses, you see, are not owned in people's names. Most businesses are owned in companies. For tax reasons, most people put their ownership of their business in a proprietary limited company. Yeah. So you're going to need to know what is the company. Who are the directors and shareholders? Yeah. Who's allowed to sign? What, if you look down there, ABN, what's its ABN number? Yeah. What's its ACN number? Right? So just that little detail about, with a property, it's just look at the title. You know who the owner is. Bang, that's it. No discussion. With a business, a little bit more complicated, and you need to make sure that you've got the correct owner, or if you're looking at a contract that an agent's provided you, you need to make sure that the agent's got the right name of the owner. Hopefully they will have done. And you can see there's all of the details, and similarly, there's all the details of the purchaser. Now, because very often a purchaser is told by their accountant, we're going to put this business in the name of a company, I'm going to form a company, for it doesn't exist yet. So when that's the case, you will often see that the purchaser is shown as Brian Sander and or nominee, right? And or nominee, meaning before settlement, I will nominate who is going to end up being the owner of the business as the buyer. It may well be a new company. So you will often see that on contracts. The buyer is somebody and or nominee. So then you've got to end up, if you're acting for the buyer, to find out, well, who is your nominee? And you got to get special forms signed for the purchaser to nominate who's going to be the buyer. That's easy though. Then you've got the name of the agent, and you can see on this particular one, because I printed these off my own computer, it's got our name already printed in there and our details. But that just gives you all of that. Then you've got a space for the name of the business, a description of what the business does. That's important. You'll see later on, we have to put a restriction on the owner. If you've just sold a business to somebody, as the buyer, the last thing that you want is the day after the settlement is for that owner to go round the corner and rent another shop and open up another business doing exactly the same thing, right? That's not really right, is it? So there is a restriction put on the owners of all businesses that they can't do that. But what they can't do is what is described here. So this, in number 4 on the front page, it describes the business. So you have to look and say, well, does that actually describe what the business does? Well, because that's what they're going to be stopped from doing, what the description says. Question number 5 deals with the premises, the address. Question number 6 deals with the amount of money. And you can see there's a space there for GST and a place for applicable or not applicable. As I spoke to you last week, there is no GST on the sale of a business. As long as the business continues to operate, then there will be no GST. On the next page, it talks about the stock in the business, the things that the business sells. Now, at the time of writing the contract, all the vendor can ever do is make an estimate. The contract will explain how, just before settlement, the vendor and the purchaser will actually count the stock and see what's there in the shop. But until that's done, you're only doing an estimate. Because if you think about a business, every day, goods are delivered, goods are sold. Goods are delivered, goods are sold. The amount of stock in the shop changes every 5 minutes. So you're never going to be accurate until the last minute before the settlement. So that's why it says vendor's estimate. And it shows, again, GST, the amount of the stock, and then the total. The bottom one is the total purchase price of the price paid for the business plus the stock. A deposit. Do you remember? Last week we touched upon that there was a restriction how much deposit can be collected if the business is under $300,000. In the Act, it says the purchaser can't pay any more than 10% deposit. If it's over 300,000, they can pay whatever. So again, if you're checking a contract that an agent's brought in, you would just look here. At the bottom of page 7 is the total purchase price. So bottom of clause 7, the last line says total purchase price, right? Immediately under that is the deposit. So that cannot be more than 10% of the one above it if the business is being sold for less than 300. If it's more than 300, it can be. So now we've got a very interesting thing here in 9 and 10. It talks about a date of possession. Yes?
With regards to the asking price of the business and this deposit and stuff, we talked about the stock and the land, but we didn't talk about the plant and equipment. So
that's included. Plant and equipment is part of the price. No, the price includes plant and equipment.
The asking price of the business.
Yeah, the selling price.
You've got a question?
But not I'm talking about the asking price. Like when you talked about the $300,000, doesn't include stock.
Yep.
Doesn't include plant and equipment.
It does include plant and equipment.
The 300, it does include plant and equipment.
Yes.
I've got a question. If it's more than 10% deposit, will make the contract void? Or?
Yes, it can make the contract void.
Okay.
If the sale price is less than 300.
Yeah.
If the sale price is more than 300, it can be any amount. Yeah. It's only 10% if the sale price of the business is less than 300. Okay, so now here, 9 and 10, you've got two things that you don't see normally. One is called a date of possession, and the other is called settlement date, right? There are two different dates in a business contract. How does that work? Well, you will see...
Quarter past.
Sorry?
Quarter past.
Bang.
Oh, thank you. Quarter past. 41 minutes, yes, okay. Okay, back on again. Well done. Quarter past, so let me know at 8 o'clock. Okay, so that's... Where did I start? I forgot what I did. Totally thrown me.
And the paper.
There it is. Good. Okay. So, as I said, all the way through, everything in the sale of a business talks about the vendor's estimate of stock. And let's just say that it's a little lunch bar. You all go into lunch bars most days. You know, a little lunch bar. It's got drinks and chocolates, and you go and get bread. And all that. There's never a lot of stock, right? So the vendor's estimate is, in my lunch bar, there's $10,000 worth of stock in my shop. That's it. Okay. So all the way through, everybody's worked on the fact that there's $10,000. Now comes stock take. So traditionally, settlements for a business traditionally fall on a Monday, the first day of the working week, whereas people settle houses usually on a Friday so that they can move into the house over the weekend. But with businesses, people look at most businesses for the way of paying wages and things like that. Things start on a Monday, so business settlements will often be on a Monday. It's not written in stone, but it's very common. So these days, businesses are either 5 days a week, 6 days a week, or 7 days a week. So if a business is a 5-day-a-week business, if settlement's going to be on the Monday, the last working day under the old owner is the Friday, right? Friday night, 5 o'clock, that's it. No longer going to be open until Monday, and on Monday it's the new buyer's business. If it's a 6-day business, then it's Saturday. If it's a 7-day business, it's Sunday. But whatever day it is, one of those days, the business will close for the last time under the ownership of the old owner. Okay? So that's the end of the trading under the owner. At that moment, whenever that is, the stock takers arrive. Okay? And depending upon how much stock, they will come with 1, 2, 5, 10, 20 people. Okay? And they will physically count the stock. They'll go through and they'll say that in the drinks fridge there's 10 375ml cans of Coke, and there's 2 1-litre bottles and 4 2-litre. Add it all up. Exactly what's there. And then, because they are experienced stock takers, they know the cost that Coca-Cola charge the owner. So a stock take is not done at the price that you and I pay. A stock take is done at the price that the owner buys the stock at, right? Wholesale price. So they work it all out add everything up in the whole shop. These days with computers, it's in some bigger businesses, all the stock's on computer. It can be done even easier. But just say in a small business, they won't do it by computer. They'll literally do it by hand, and they'll add it all up. And all the way through, we've said estimate is 10,000, and it turns out when they add the stock up, it's $9,487. Bang. We now know exactly how much stock there is in the shop because the business is closed. No one's going to buy anymore, no one's going to deliver anymore. Okay? So they fill up a stock certificate and they email it to you guys. Because on Monday it's going to be settlement. So now you know that this person is paying X thousand dollars for the business plus stock. You now know how much exactly the stock is. So you can do your final statements for settlement. Okay, so everybody's agreed. The vendor's there, the purchaser's there, everybody has agreed. That's it. They fill in the stock certificate, vendor and the purchaser both sign it. Bang.
So this is a prescribed document, this stock
No, it's
certificate?
just a stock certificate. It's just it can be just the stock takers certify we've counted the stock and it comes to X dollars, right? And then the vendor and the purchaser both sign and say we agree.
So they engage someone to do this?
Yeah.
Yes, the stock taker is an independent person.
Okay.
Oh, okay, so that's
They are a
requirement?
company. Stock takers are a separate company that come in and charge a fee for counting stock. That's their job.
And it has to be an independent person?
It has to be an
required.
independent person. Well, it doesn't have to be, but from the purchaser's point of view, it's much better. Because the purchaser doesn't know what price the vendor pays. If the vendor does the stock take, he can say to the buyer, oh, I buy these at $1. Well, he really only buys them at 50 cents and he's making a profit on the purchaser. So the whole purpose is the purchaser should buy these at the same price because he's then got to sell them on Monday to you and I. So if he's paid too much for them, he's not going to make a profit on them. So that's why it's important that it's an independent person. And normally it's done by the stock taker says to the vendor, show me your invoice from Coke, where you bought these cans of Coke. And here it says, we sold you 2 dozen cans at 50 cents a can from Coke. So the stock taker knows those cans are 50 cents each.
What happens with a 24/7 business like a convenience store or a service station?
These days there are a few of those. If they change hands and they physically have to put notices up to the public, this business will be closed for 2 hours on Sunday night from 10 till midnight for stock take. Bang. They have to create a moment where there is no trade so that they can actually identify what the stock is at a given time.
Okay.
All right, so everybody's agreed. 9,487. Now, if the purchaser leaves, let's say this is Friday night, after business, Friday night, it's a lunch bar in town, doesn't open Saturday, doesn't open Sunday, so 6 o'clock Friday night, we do this, bang. It's all purchaser signed off. I'm buying 9,487, and on Monday morning when I open up the shop, that's what I expect to find. $9,487 worth of stock. If the stock taker gives the keys back to the owner, what could happen over the weekend?
They only
They
do
go
it.
to
Takes
take stock.
everything out.
Right. So what does the stock taker do? He gives the keys to the purchaser. At the end of the stock take, he gives the keys to the purchaser. Purchaser has just signed off to say, I accept that there's $9,487 worth of stock here, so he gives the purchaser possession of that stock by giving them all of the keys. The vendor hands over all of the keys to the business. So the purchaser is now in possession. They're not trading, but they've got possession.
And that's a requirement?
Absolutely, that's in the contract. That's what it says, that the purchaser will get possession at the end of the stock take. Read what it says there. On page 2, clause 9, date of possession on such and such a day, at the close of the day's trading and on completion of the stock take. Right? That's when the purchaser gains possession. Now, I act for the owner. Right? How am I protecting my owner? I've just given the keys of this business to the purchaser on Friday night. Settlement isn't until Monday morning.
That's right, it might fall through.
He might not pay. He might run away. How do I protect the buyer? Well, I only allow stock take to happen if on Friday afternoon by 3 o'clock you have rung me to confirm that you've got all of the purchase price in your trust account,
So
and you have an irrevocable authority to pay that money at settlement. Right? If you do that, then I allow stock take to happen. If you don't let me know that you've got all of the money in your trust account,
Cleared funds.
I cancel the stock take until you can tell me that you've got it, right? And I'll show you where that's all written in. This is what happens in real terms, in practical terms, right? On the last working day, in the afternoon, the conveyancer confirms that they are, either they've got all the money, or they've got all the money less the money that the bank's providing. So if people are borrowing, the bank will have some, and the conveyancer will have some. So they have to confirm that they've got the funds. They are in a position.
And the bank funds.
Yeah, the purchase.
They're in a position to settle. Yes, right. Then we let stock take go through. That's how it all happens. So then that's why you've got 2 dates. First date is possession, when the stock take takes place. The second date is the date of settlement.
Oh, okay.
Okay, and they're different dates because this has happened on Friday.
Yep.
Settlement is Monday. So they are 2 different dates.
Okay.
And the purchase, it's the only time in any document that you will do in real estate where the purchaser is given possession before they've actually settled. Right?
So 9 a.m. when business opens, or 7 a.m.
Yeah, on Monday,
Yeah,
who opens the door?
no one.
The purchaser. The purchaser's got the keys.
Got the keys.
Purchaser goes
Yeah, but-
to the shop Monday morning and starts trading because settlement is going to be at 10:30 at the
They've got the
LTA.
money. The bank's already got the money. It's
You've
confirmed
confirmed,
That's why it's
the
given
purchaser's
the
conveyancer
And that's why
has
they've just-
confirmed they've got the money.
And that's
You've
why they've
already
just-
set up an appointment.
Stop tax
Settlement will take place Monday morning at 10 o'clock. So the
Yeah.
purchaser opens the shop Monday at 7 or 8 or 9 or whatever and starts to trade
As the new owner.
as the new owner.
Yes.
Okay. They don't have to be at settlement. Right? Vendors and purchasers are never at settlement. Settlement takes place between 2 conveyancers. Right?
Yeah.
So doesn't need the purchaser or the vendor to be there. They'll be in the shop trading. So that's it. All right? So clause number 11 talks about what else is included, what assets. So you can see it talks about telephone and fax numbers, websites. These are the assets of the business that are also being sold. Anything else under clause 12? Well, normally you have, if there's books and manuals and records, things that the buyer needs to be able to run the business are all listed there in clause 12. Clause 13 talks about what equipment is going to be sold as part of the business. What equipment, clause 13 is talking about equipment that the vendor owns that they don't owe any money on. Clause 14 talks about equipment that is currently encumbered. Currently there's a debt on it, but that the vendor is going to pay that debt out by settlement. That's 14. 15 is where there's a debt and the purchaser is going to take over the debt. That may be the case, it may not be. 16 talks...
Sorry, can you give me an example of something that the new person will take over the debt?
Okay, let's just say that 6 months before, a lunch bar, you go into the lunch bar, right? The owner realised that the counter and the refrigeration was getting pretty old. So he went and spent $50,000, $60,000 getting beautiful new counters, refrigerated cabinets, all of that. Okay? He couldn't afford it, so he took it on a lease. Right? And then he's paying for it on a month-by-month basis. Okay? Now, to pay that all out, he's not going to end up with any money from the sale. So it's agreed. Part of the deal is whoever buys it will take over making those payments. Right? So they'll pay less money for the shop and they'll take over the debt. Okay? So that would be an example. 16 talks about anything which is excluded. Any equipment that is not being sold. Like very often, when you have a list of equipment that people get depreciation on, which is a tax deduction, they include in there their own cars. Because that the more valuable plant, the more depreciation they get, which is a bigger tax deduction. So when you look at a depreciation schedule for a business, which is the list of its assets, often you will see the owner's car there. But that's not being sold. So when it says here excluded, it will often be what's excluded is the owner's private vehicle, right? Is not being sold as part of the business. He's been claiming it for tax purposes, and the new buyer will do the same. Number 17 talks about third party. Third party is, I was describing to you, Coke, the Coke fridge or the drinks fridge, right? It doesn't belong to the owner, it belongs to Coke. As long as he keeps filling it up with Coke, we talked about it last week with the Form 2. So that's third party equipment. Equipment which is going to stay in the business but doesn't belong to the owner. So there can be no confusion. The purchaser doesn't believe he's bought that. It's clearly saying, no, you didn't buy it, but it's there. It will stay there. Yes? No? No? Oh, sorry, I thought that was a question. Okay. Now, in some businesses, there will be agreements that we need to be aware of. Warranties. Some businesses, you sell items of equipment and with them you sell a warranty. So the purchaser needs to be aware that he's going to be responsible for warranties of items of equipment that the vendor has sold. In most cases, the purchaser doesn't have to do anything. If someone brings something back which is under warranty, what happens? They parcel it up and they send it back to the manufacturer who fixes it and sends it back. But just simply so that the purchaser is aware.
Take over, just like with the debt.
They take it over, yes?
Yeah.
Advertising. Somebody might enter an advertising contract, a radio show, a program, television, cinemas. You go to the cinemas and before the main film starts there's all those advertisements, right? They're on contracts. People have agreed to pay for 6 months. That might be right in the middle of one of those that the business gets sold. So the purchaser has to be made aware there's still 3 months to go on that. You know, you can't cancel it, we've signed a contract. But usually they only do those things because they're useful. So it's not a bad thing, but just simply you're making the purchaser aware. It says other. One of the biggest things that is other is gift certificates. Right? Who's bought for a friend or a family member for a birthday or whatever a gift certificate? So what happens when you buy a gift certificate? You go in and you say, I want a $100 gift certificate, and you give the owner of the shop $100, and he gives you a bit of paper. And you then give that to your friend. Do you know that only about 70% of those ever get cashed in? About 30% of gift certificates, the person who gets them never takes them into the shop and claims it. So this is very good for the owner, right? He's got $100 for something that nobody ever comes into the shop to say, well, I want my $100 worth of stuff. But if you're buying a business, you want to know there's 300 gift certificates out there that haven't yet come in, right? What are we going to do about that? So there's all sorts of ways they get dealt with, right? I just told you the figure, 70%. Traditionally, the owner gives the purchaser 70% of the value, right? And the purchaser therefore may get lucky or he may not. It just depends. But on average, about 70% of them only get cashed in, right? That's just one of those things of life. 19. For almost every business, and it will vary from business to business, the owner agrees to spend a little bit of time, it could be 2 weeks, it could be 4 weeks, it could be longer, working with the buyer after settlement at no cost to help the buyer learn the business. Right? That's a period of assistance after X number of trading days after settlement. 20 and 21 and 22, you're advising the purchaser, is there anything he should be aware of? Are there any claims or demands or disputes about the business? 21, are there any orders from the landlord? Now, if you think back last week to the Form 2, these are almost exactly the same questions that were in there. Yes?
I've got a question regarding period of assistance. It
Yes?
doesn't specify how many working hours the owner have to be set.
No, it doesn't.
Yeah.
It says a period of assistance is the number of trading days.
So I have to stay there for 8 hours, or
It depends what you agree with the buyer. Usually you will find 8 hours a day for the first week. Right? First week they know nothing. They need you very much. Right? By the end of the first week, it depends on the business. If it's a lunch bar, After a week, they probably say, don't worry, we've got it. But if it's a very complicated business, like a large engineering business, you might be needed for 3 months to help them. So it changes according to the business and according to the degree of difficulty, right? So it's something which is negotiated between the seller and the buyer on every deal.
Will be put on contract?
Once they've agreed it, then they put it in the contract.
Under 23, the special conditions, or 24?
No, 20 under 19, period of assistance.
Yeah, but the hours, they would put that under the special conditions. All the
Oh no,
details,
then
how
they
many
put it
hours.
under 24, a term. It's something. A term is something that's agreed, right? When people have agreed something, it becomes a term. So if they agree that for the first week you'll work 8 hours a day, 6 days a week, second week you'll work 5 hours a day for 5 days a week, and the next 2 weeks you'll only work 2 hours a day for 4 days a week, and they agree that, so then you write a term there under 24 to say the parties agree that the period of assistance will be this, and you spell it out. Bang, bang, bang. Then there's no argument, there's no discussion. Okay? The difference between a special condition and a term. A special condition is something by which the contract falls over. If it doesn't happen, finance, right? If the buyer cannot get the money, they can't settle. So that's a special condition. I'll buy this as long as I can get the money, right? If I can't get the money, deal's off, right? But I'll buy this on the basis that you and I have agreed you're going to work X hours. Well, that's not a reason to knock the contract over. Okay, so that's not a special condition.
But like you said, if it's a very complex business,
Yeah.
then it would take
Then
months.
they
Couldn't that
may
be
do
a
it by
special
contract.
condition? That's
They
right.
could do it as a spec. It's not really a spec because it's only going to happen after settlement.
Yeah.
So how can you make something that's
Condition
a condition of settlement that's not going to happen till after settlement? What you can do is you can make a special condition. This contract is subject to the buyer and the seller agreeing a work contract for the vendor to work in the business for the first 3 months, right? That way you nail down, and it becomes. Then if he doesn't do it, he owes you money. So there's ways around it, but it's not really a condition because it's not going to happen until after settlement.
Okay, so you could put it under, just to clarify, you could put it under 23, this contract is subject to a work agreement being agreed to, blah, 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 and then in 24 you put down all the details.
You could do it that way. Yes, that's exactly right, because the work agreement has to be signed before settlement, right? But the actual details of what the work is aren't going to happen until after settlement. But it is conditional upon the fact that he signs that work agreement before the settlement.
But work agreement is not that enforceable on the employee, actually. The employees can just walk away.
Oh, no, we're not dealing about employees. You can't contract people who aren't owners, right?
Okay.
It's only about you as the owner.
Okay.
So, yes, you're right. Law of contract says you can't make the contract subject. When we get this, someone says, well, there's a very important person in that firm. We want you to make that person guarantee they'll stay. They're not an owner. They can't. They have nothing to do with the contract. The contract is between the buyer and the seller. Right? A staff member has nothing to do with that. So you cannot ask them to be a part of this contract. All the buyer can do is meet with the staff before settlement and discuss, I'm going to be the new owner. Are you happy to stay? I'm happy to offer you a contract of employment when I'm the new owner. Would you like that? They can agree the deal. This happens regularly. They meet with the staff and then they can set it all up after settlement, right? But you can't make a contract subject to the key person staying on, right? Because nothing to do with them. All right. So here we go. Clause 23. You list, and we're going to look. I've included in this contract as most of the normal special conditions, but here in clause 23 is where you write them, and on page 20, clause 24 is where you put down the special any terms, as we talked about the difference between a special condition and a term. So when you turn over the next page to page 6, there are 3, and the same occurs with the conveyances contract. There are 3 areas with the staff. There are 3 things that can happen. Okay, when somebody buys a business, they can make the decision that they don't want to keep any of the staff in the existing staff. It's the owner's responsibility to fire them all, the settlement, and the purchaser takes over none of the staff. It's a very unwise thing to do if you think about it, right? Unless you really, really know that business extremely well, you're getting rid of all the people who know how to run it. So, that very rarely happens. The next thing is that the buyer may say, I want to take all of the staff. But at the time of negotiating the contract, the buyer hasn't met or talked to all of the staff, so they don't know whether they're going to want them all or they're not going to want them. So the most common is this one, where it says that the buyer agrees and the seller agrees that the buyer will take some of the staff, but he doesn't know which ones. But between now, the signing of this contract, and the settlement, the buyer will meet with the staff, and then he'll make, and you'll see it says here, no later than 14 days before settlement, the buyer must tell the owner which staff he's going to keep, which staff he's not going to keep, so that the owner can, the ones that are not going to be kept, the owner can give them notice. Okay? Now, when you deal with staff, you've got issues. Staff have legal staff entitlements. You all understand that? Almost every ward, everybody who works for anybody gets 4 weeks holidays a year. Okay? So everybody has to be paid 4 weeks, and if they haven't taken all of their holidays from 1 year, they may have more than 4 weeks holidays, right? So that's an owner's responsibility. It's under the law, the owner must pay that, so the owner must make sure that all of his staff's back holiday pay has been paid. That's the owner's responsibility. And in here, you'll see under 5, leave entitlements. Okay? What the purchaser is entitled to, what becomes responsible for, and what the seller is responsible for. But the one that causes the most problems is long service leave. Now, I don't know how many of you are aware, but in almost every act, in every award in Australia, if somebody works in the same firm continuously for 10 years, they are entitled to long service leave. And in most awards, long service leave is 13 weeks paid leave. Okay? At their current, the highest rate, the rate they're on the day they become due at 10 years. So even though they weren't earning that in year 1, the 13 weeks are being at what they are paid today. So 13 weeks at 10 years. But just to be fair to staff, at 7 years employment, you are entitled to 70% of that. At 8 years, you're entitled to 80%. At 9 years, you're entitled to 90%. And at 10 years, you're entitled to the full 13 weeks, 100%. So, one of the things an owner must do is advise a buyer, here's a list of all of my staff, and here's a list of the days they started. How long have they been employed? So that a buyer can see what the situation is with staff, long service leave, etc. Now, the law is very clear. 7 years, 8 years, 9 years, 10 years and above, very definite what the staff member is entitled to. But what about a staff member who's been employed for 5 years? Now, the law says he's not entitled to any long service leave. But if you're the buyer, that person has worked there for 5 years. In 2 years' time, they will be entitled to 70% of 13 weeks paid leave. But you will only have had the benefit of employing them for 2 years.
My question is, when I bought the business, actually I create a new company. Actually, that
doesn't know the law. You sack them on day one. You change the name of the company. The staff entitlements flow. If you employ that staff person, their entitlements go with them.
Okay.
I got that. That's what the business did. They changed
Yes.
two owners, and I still worked in the same business though. But they thought they'd try and get out of it.
And did they?
No.
No, that's right. Still got that. The law has been changed to protect staff. People were doing this, just playing games to try to save the money, right? But the reality is, if the staff have been loyal and worked, they've earned that long service leave. So the truth is they deserve to get that. So the issue then becomes, how do you deal with people who are close? So usually there's a negotiation, right? And the purchaser gets a small discount off the price to cover staff who are maybe at 5. The traditional cut-off point is 5 years. If you've only worked for somebody for 4 years, you probably won't be covered. You won't get protected. And you will get protected if they employ you, but the purchaser won't have to. The vendor won't have to pay out that situation. That's what I'm trying to say. Right? But it is an area of discussion, and this special condition, which goes all the way through on page 6 and page 7, spells out the way that is dealt with. If you then look, page 8 says a list of who's going to stay. But it says details to be provided to the vendor no later than 14 days prior to settlement. Then the next page says the list of the people who aren't going to stay. Details to be provided to the vendor no later than 4. So it gives the purchaser the time after signing the contract to meet the staff and make a decision. Then on page 10, both of them sign that this is what's going to happen. The next special condition on page 11 deals with finance. Right? We said the most common thing is that somebody buys a business subject to finance. So here on clause 11, all of the things, how much finance they're going to borrow, how long they're going to borrow it for, what's the security. The agent has to fill all of this information in so that you know the buyer tells exactly what he's going to borrow and what he needs. And then by which date. You'll see 4.2 talks about a date by which the finance must be obtained. Okay? And 4.3 says who it's going to be borrowed from. So it gets a lot of detail. Special condition, the next one is on page 12, which is the lease. We've talked about the fact that there is no title for the business, but there is a lease. So for a buyer, it's very important that either the existing lease is transferred to them or they get a new lease. So you can see on page 12, the top part deals with, just supposing the lease is 5 plus 5. There's a 10-year lease still running. So most buyers are going to be happy with that. So therefore the top part says it's subject to the transfer of the existing lease. And there's all of the details there about the lease. But if there was only a year left on that lease, the buyer would say, no, that's no good. I don't want that lease. I really want a brand new lease. So they make the deal subject to going to see the landlord and the landlord giving them a brand new lease from settlement. So that's the bottom part of that page, is where it makes it subject to a new lease.
Is that lease transferable?
Most leases are transferable, yes.
We don't like this new tenant.
Well, the landlord does have the right to say that, but it has to be very specific grounds. He can't just say, I don't like the look of him. There's got to be a real reason. He may ask him to give him financial information about how much money he has. Can he afford the rent? And that's what the landlord's interested in. Can the tenant afford the rent? Right? So, yes, so there are some grounds that a landlord can say no. Not many. It has to be very specific grounds. But he can say no. So I talked earlier, I said to you that, the one thing you're trying to stop is if the old owner goes around the corner and opens up a new business. So here's this clause on page 13 called a deed of restraint, right? Where the vendor agrees that, look at number 1, it is hereby agreed as follows. From the date of this deed, the vendor agrees that the vendor or any of the persons will not do any of the following things for a period of X number of years and within a radius of X number of kilometres from the business. So basically you are putting a ring around the business and saying for the next 2 or 3, you normally don't do it any more than 2 or 3 because after you do it more than that, it's unfair on the vendor. You can't block them out forever of working in an industry, right? But usually within 2 or 3 years, the business has made enough money that the purchaser has got their money back. So you've protected the purchaser for as long as it takes them to get their money back out of the profit of the business. So that's the years. And the distance, well, it depends. If I was selling a lunch bar, well, here we are, we're in Light Square, right? Okay, and I'm selling a lunch bar just across the road in Light Square. And I've got to decide, so how far am I going to stop my vendor from being in another lunch bar? Well, if you go and walk up, what's this street? Curry Street, okay? If you walk between here, TAFE, and King William Street, how many lunch bars are you going to go past? About 10, right? So there's already a lot of competition and the business is still doing okay. So therefore, in a deal like that, you might say 400 yards, 400 metres. He can't be any closer than 400 metres. But if I was selling a general store in a country town, and it's the only general store in town, and the nearest town is 50 kilometres away, so I'd say, well, he can't open up another general store inside of 50 kilometres. So it's got to relate to the business that's being sold. Okay? If it's too harsh, the court will throw it out and say it's unfair. Okay? So it's important that the broker thinks about this restraint and makes it a fair on both sides. Fair on the purchaser, fair on the vendor.
Regarding the restraint, I think I learned something from another course. It said you can put some option on that.
That's what they call a waterfall. They put
waterfall.
Yes, that's right. Your lawyers love that. They do 3 years, and if not 3 years, 2 years, and 2 years, if not 2 years, 1 year. They, in case the court throws one out, they've got the next one.
Why they didn't put the
because it is a stupid clause, right? Because if one's wrong, they're all wrong, right? So to say 3 years, and if not 3 years, 2 years, the moment it's not 3 years, the other two are out. So you've lost it anyway. So it's better to use just one and make one that's realistic, right?
So what are we talking about here? What clause?
No, it's don't even worry about it. It's not there. It's a different. Where this says here for a period of time and a distance, that's what we use in this contract. Some lawyers use an alternate system, which is quite complicated and, frankly, doesn't make a lot of sense. So don't worry about it. You won't ever see one in a real estate contract. Yeah, it's just how lawyers earn their money, by trying to make things complicated. So this is the deed of restraint, and where it's saying that the owner can't do these certain things. Now, turn over the page, because what you have to remember I said to you, for most businesses, who owns the business? Who's the owner of the business?
Depends if it's settlement or after settlement.
No. When you're writing up the contract, remember on page 1 I said...
Registered person, the director.
Well, yeah, but why... So the owner of most businesses is a company. Okay?
Yeah.
So a company is made up of directors. So you've not only got to say that the company can't open up the business, but you've also got to get the directors as well. So here on page 14, where it talks about the associated persons are the directors, usually the husband and the wife, who actually work in the business. So they also are saying that they won't open up a shop, right? So you've got the company signs it, and you've got the directors who sign it. So there's the directors on page 14. And then here on page 15 is where the vendor signs it, either as a person or as a director of a company. And then on page 16, the purchaser signs it. And then on page 17, the associated person. And the associated person is the directors again. So you're getting everybody to sign this document to say that they're not going to open up again. On page 18, I've given you an example simply of a blank. Right? So the contract, if there is in a particular deal a special condition, up to now, all of these have been printed, right? Special conditions, you've just got to fill in the blanks. In some deals, there's an extra special condition that is not a normal one. We're going to have to write it. So there's a page there where you can write extra special conditions. Page 19 says that the contract is subject to due diligence. Due diligence is a legal term which means that you do checking. You get the accountant to check. The purchaser gets their accountant to check everything to make sure that everything that they were told is exactly as it is. And this says that they've got, you'll see in one, the vendor allowing the purchaser to investigate the due diligence prior to. So you give the purchaser a period of time, 2 or 3 weeks, to just do a double check. And if they're not happy, if they find something that wasn't what they believed, they are allowed to cancel the contract in that time. If they don't do it, number 6, if the purchaser does not exercise the right of termination within the due diligence period, then it's deemed to have been satisfied. So it's up to the purchaser to do something. They are given this free period to look over the business and make sure they're happy. If they're not happy, they physically have to do something. They have to write a letter, say, no, we're not proceeding. If they don't do anything, Clause 6 says, if it comes to that date and the purchaser hasn't done anything, then it's too late. They're deemed to have been happy and the sale is on.
So is it like a notice to terminate the contract?
It's like a notice to terminate that the purchaser's got for a couple of weeks after.
Another word for cooling off?
It's an extra cooling off, if you like. Now, that's not in the law. That's something that brokers do so that buyers feel comfortable, right? So now we're on to page 20 of this, and the whole of page 20 is just talking about explaining what words mean. Page 21 is where the the terms of this contract start, and the thing I want to show you is halfway down page 21, item number 4, payment of the deposit and balance of the purchase price. So it says the purchase price will be paid as follows. Purchaser will pay the deposit into the agent's trust account on a date nominated. The purchaser will pay an amount equal to the balance of the purchase price, including the vendor's estimate of stock in trade, less any monies which are to be borrowed to the conveyancer or legal practitioner or the agent on or before 3 p.m. on the last business day prior to the date of possession. Right? So this was what I talked to you about when I told you about how this worked. Right? So it says in the contract that the purchaser must have paid the balance of the money to the conveyancer by 3 p.m. on the last working day before the stock take is going to happen. Okay? So that spells that out. If you look down to clause 5 and 6, which talks about the stock take, and there's 2 options. A stock take can either be a private stock take, which means it's done between the vendor and the purchaser. That's 5. Or 6 is an independent stock take. Now, as an agent, that's what we always recommend. We recommend you get an external professional to do the stock take. That protects the buyer. And there it says, the value of the stock shall be appraised by an independent appraiser appointed by the agent. Okay? That's the key word, appointed by the agent. So the stock taker is answerable to me. Okay? I don't pay for them. The vendor and the
vendor's agent or the...
Well, that's the only agent in the... Yes, the vendor's agent. Yep. If clause 4 hasn't happened, if you haven't rung me by 3 o'clock to say we have the funds, I cancel the stock taker because I appoint the stock taker, I have the authority to cancel the stock taker. So that's just explaining in the contract how this all works. Okay, so it's all spelled out in the contract. Clause 7 talks about the plant and equipment. The value of the plant and equipment that's being sold, you'll see if you look at the price, if you go back to page 1, just quickly, the bottom of page 1, the purchase price, it says goodwill including plant and equipment. Right? We do not define an amount of money that is being paid for the plant. It is all in the lump sum. And here it says that the value of the plant and equipment is the same amount as the depreciated value. That's the taxation amount. Because if the purchaser pays more than that amount for the plant and equipment, the vendor's up for a capital gains tax. You don't need to worry too much about that, but it's just simply to understand why we don't say that the price is X for the goodwill, X for the plant and equipment. It's all in one figure, so that there is no possibility of any capital gains tax on the vendor. Clause 8 is where your authority is.
Podcast.
Sorry?
Podcast.
Oh yes, you're right. Gosh, we're going quickly tonight, aren't we? Okay, off again, part 3. Clause 8 is your authority to do adjustments. Everything, rates and taxes, insurances, anything that needs to be adjusted is adjusted under the authority given to you in page 8 as of the date of possession, right? So everything goes back to this date here. The date that the stock take is done is the date of possession. Everything is adjusted back to that date. That's clause 8. Clause 9 talks about what are the vendor's obligations. So the vendor has to assist in the settlement by making sure that they sign all the documents, they arrange everything and do everything that they can to assist in the settlement. Clauses 10, 11 and 12 explain what we talked about when we talked about encumbered items and non-encumbered items, excluded, that's all dealt with there. Clause 13, the owner must use their best endeavours to run the business from the day of this contract through to settlement and not make any changes or do anything that's going to amend it. Clause 14, now when you study the settlement of real estate, you will get taught that when a buyer signs a contract to buy a house, from the moment they sign the contract, they have to take out insurance, right? Have you dealt with that?
Yes.
The risk is with the purchaser from the moment a contract is signed. Clause 14 tells you that in a business, the risk stays with the owner until date of possession. So the purchaser doesn't have to take insurance on a business until the date of possession. The owner... Sorry?
So it's
The other way around. Like so many things in the sale of businesses, it's the other way around. 15. All the costs and stamp duties the purchaser basically pays. Except these days, now, there is no stamp duty on a business. The very first thing that the government removed stamp duty from was the sale of businesses. So there is no stamp duty on a business any longer. Not for the last couple of years. Which is a good thing for a buyer. Prior book debts. Some businesses... Sorry?
If that's a business with property, then it's still no stamp duty?
No, stamp duty on the property, but not on the business.
Okay.
Yeah. Prior book debts. Some businesses, run accounts. So, obviously, any money which is owing to the business, as of the date of possession, this date, when the purchaser takes over, any money owing to the business is the vendor's money. As that money comes in, the purchaser passes that money across to the vendor. It's the vendor's money. Any debts that were owed to the business up until the date of possession. Clause 17 deals with special conditions, and it's exactly the same as the property. If the contract is subject to a special condition, and the special condition doesn't happen, then this contract can fall over. Right? Just simple as that. Clause 18. I've been selling businesses for 30 years. I don't think I've ever had a default by a vendor. I've never got to a settlement day and the vendor has said, I don't want to sell, right? But if he did say that, then that spells out what the rights of the buyer are. Clause 19, I've had lots of times. You get to settlement date and the buyer suddenly gets cold feet and says, I don't want to buy, right? Now that spells out the rights of the vendor. The biggest right, of course, is that if the buyer doesn't go ahead, he or she will lose their deposit. Right? The purchaser loses their deposit if they default. There's a difference between default and having a special condition that isn't met. They're legally entitled to cancel the contract and get their money back. But if there's no reason why they just don't want to go ahead, and sometimes people get scared and just decide, no, actually had one happen in the last 3 months, one of my staff. Only a small business, but on the night that they went to do the stock take, and it was less than this, the purchaser just said no. just don't want to do it. And we said, well, if you pull out now, you're going to know, hadn't paid a big deposit. I think, well, big in relative terms, I think they paid $10,000. That's it. Give it to the vendor. I'd rather lose the 10 than I don't want to go ahead. And that's exactly what happened. They lost their deposit.
So you paid 10,000 deposit.
Yes, and then didn't
count.
and then didn't count.
What do you get?
We got half of the 10.
Everyone's happy.
And we've still got the business to sell.
Oh, double dipping, eh?
Well, it's true. We didn't do it. It wasn't our fault. So. Anyway, so, default by the purchaser. Clause 20, warranties by the vendor. So the vendor is saying that all the plant and equipment they own, it's all in working order, that the financials they've given to the buyer are correct, etc., etc. It's just a little bit of reassurance to the purchaser. Clause 21, restraint of trade. In this 21, the vendor is agreeing that they will sign that special condition about restraint of trade. It's considered that important that it actually gets mentioned on its own there. Then 22, 23, 24, they're just technical things about the settlement, waivers, how notices are served. If one part gets done with it, it doesn't destroy the rest of the contract. 26, the purchaser is saying that they are buying this business based on their own investigation, that nobody has forced them or put any undue pressure on them, right? So that's the purchaser agreeing to go forward. 28 acknowledges that there is a GST in Australia, okay? But 29 says that the sale is being sold as a going concern, and because it's a going concern, GST is not applicable. Then, immediately under that, you've got clause 30. In the very, very rare situation, and I only ever had one in a lot of years, where the business was sold, was closed down, so it was not a going concern, so the buyer did have to pay GST, so then we crossed out 29. But traditionally, we cross out 30. You say 29 is right, there is no GST, so you cross out 30. One of the two, 29 or 30, must be crossed out. They can't both be in there. 31 deals with privacy. It's very important. Lots of people like to know, because it's not on the title, you can't actually find out how much did somebody pay to buy a business. There is nowhere that you can go to find out as public record what somebody paid for a business. But lots of people would like to know, right? Particularly, one group of people that always want to know are the landlords. Landlords always want to know how much a tenant got paid to sell their business, right? Because they understand that if a tenant gets a big amount of money, the business was probably quite profitable. So that means they can pay more rent. So landlords always want to know. So we always use clause 31 to be able to say, I'm sorry, we're not allowed to tell you under the Privacy Act any of the conditions of the contract. So that annoys landlords enormously, but we use that. And that's really the end of that. And then the next page, signing page. And just the only interesting thing, if you look at page 26, the signing page, where it's signed by the vendor, if you look at it, there are 3 different ways that an owner can sign. At the top, it's where the vendor is an individual. Right? Just a person signs at the very top. But in the middle, if the vendor is a company, a proprietary limited company, so then you've got the middle bit there where there's the name of the company and their ABN number, and then the person who's signing signs as a director. So that's that second bit. And then right down the bottom, if it's a public company, right, listed on the share market, so it's then not owned by somebody, it's a duly authorised officer has to sign. So there are 3 possibilities of where the contract can be signed. Only one of those applies, obviously, in each case, but you don't see that on a residential contract because they're normally just owned by a husband and wife. Right? Then you've got the purchaser signing on page 27, and it's exactly the same. At the top, if the purchaser is an individual; in the middle, if the purchaser is a company; and down the bottom, if the purchaser is a public company.
So up the top, an individual that includes a sole trader, don't they?
That's a sole trader,
You
yeah.
still have an ABN, but you're not a company, you're just a
Yes.
individual, yeah.
Yeah. Yes, mate.
I have a question in regards to the restraints. Now that a lot of exchange of business is done on the internet, how do you put a restraint on that?
Oh, you mean a business that operates on the internet
Yes.
only? There's no premises?
Maybe for a warehouse, but that's about it.
Yep. Be very difficult to actually restrain someone on the internet. I haven't sold a business that I've sold. There's a lot of businesses that we sell have a website, have an internet presence, but they also have a retail shop or they operate from home. I haven't sold a business that only has no physical presence anywhere. So that'd be a very interesting question. How would you restrain the owner? I have to think about that one. I don't know. Would be tricky
You're
to.
talking about someone like Kogan, who is a website.
Kogan, Amazon, Iconic
and
Clothes, there's a bunch of them now.
Yes, okay, but they're very unlikely to be sold as businesses. It's not like you can go into the sort of businesses that we talk about that we handle. Yeah, I understand that. I mean, but Kogan, these are huge enterprises. The only sort of people that would buy someone like Kogan would be Amazon, another huge business, right? And they're probably not going to use a business broker anyway. So they'd work out some deal between them as to how that would happen. It's a very good question.
Yeah, but it's actually not necessary because you think about it. Even if Bezos be allowed to set up another company called Amazon 2, can the Amazon 2 compete with Amazon? At this time, Amazon becomes so big. It's actually not possible, right? Because nobody recognizes that Amazon 2 probably you cannot be called Amazon because they can sue you for pass-off. You can only call something like a very different name. And given that Amazon is very, very large, significant amount there, so you set up a new company to compete with them, you got no chance.
It would be difficult. You're right. I understand what you're saying, and that is a true point. But it's an interesting exercise, though, to think about how it would be protected. Okay, so we've spent an hour and a half on the real estate one. We've got, as you can see, it's and that's just out of curiosity, by the way. When I sign a buyer or a seller who comes into my office to sign up to buy, that's about how long I take to go with them, to take them through the contract. I don't ask them to sign this contract until I've explained it to them. So I normally allow between an hour and a half and 2 hours with a client if they're coming in to sign a contract. And you might think about that as well. If you have to do private ones, you need to take time and make sure that people understand these are legal documents. I know they're not drawn up by lawyers, but they're still legal documents, right?
Do you need to tell them that they can get independent advice or legal advice if they need to?
It says there somewhere. It says there somewhere.
Is there an obligation?
It's not an obligation, but if they ever ask, I always say yes. We can print it off.
Okay,
So take it.
You're not obliged to say that though, to them.
Take it to your accountant. Take it to your lawyer. Take it to your conveyancer. Get advice.
Yeah.
We normally tell them to get advice before they come and sign it, right? So they know what they're doing.
Yeah.
Regarding the signature witness, can anybody be a witness? If they come and husband and wife, and the husband sign, the
Yes.
wife be the witness?
Yes.
Fine, right?
I think the only restriction is it's got to be an adult,
Okay.
right? And that's about it. These days they're
Can
not.
be related.
They can be related, yes, if they're not a party to the contract.
So
Like if the seller is a husband and a wife, then the husband can't witness the wife and the wife the husband. No, had to be enough. But if the business was only owned by the wife, the husband could witness her signature. Right? That would be not a problem. Any other questions about the real estate contract? Because I'm telling you now, we'll go through the conveyancing one much quicker. Because everything we have covered in here is in the conveyancing one, right? There's nothing that's not there. There's nothing extra that is there. It's in slightly different places and it's put in a different way. But the concept is exactly the same. This is exactly the same. This is a contract between a buyer and a seller. The only thing that's missing is there is nothing about the agent in there, right? So when it talks about money being held, it's money held in the conveyancer's trust account, right? That sort of thing. So there's no difference. Yes?
I got a question.
Absolutely.
As a conveyancer, do we need to keep a copy of this contract? For how long?
Well, if you are the conveyancer acting in a transaction, I think you have to keep documents for 5 years.
So I have to keep a copy of that.
Yes.
Okay, regarding the signature, do I have to keep a copy of their identification?
Oh, yes, verification.
Yeah, I think you see, you don't have to verify their signature for the contract, but don't you have to verify their signature to take instructions?
Yes, you do.
That's where you have to verify it. Right? So you've already verified who they are.
Okay.
So you don't need to get them to verify it again when they sign it.
Yeah. Okay. So at the very beginning, when they give us the
When they
instruction,
give you the
we
instructions,
must get the
is when you
documents that I
take.
put in place,
That's when
verify
you have
them.
to do all the 100 points and all.
Yeah.
That's correct, isn't
Okay.
it? So if you've done it once, you don't have to do it again.
Okay.
It's the same person. You've met them.
Okay.
They prove to you who they are.
Okay, no problem. Okay, I got it.
Brian, just earlier you said the husband and wife can't be each other's witness if they both own the business. Isn't the agent a witness to the signing?
Sometimes he will be, but again, in the private one, there's no agent. So it might be you, isn't it?
Oh, the conveyancer, yeah, the agent or the conveyancer can be the witness.
Yeah, oh yes, they can, yes, yeah, absolutely.
So, Brian, just a quick question. I'm going backwards, but number 12, when you said other, information relating to the day-to-day operation of business or which may be necessary, convenient or incidental to better enable the business to be conducted. What was an example for that?
So where again?
That was page 2.
Right. Okay, so just say it was a franchise business.
Yeah.
So it would be all of the manuals and the books that tell you how to do things. I mean, the thing about a franchise...
To properly run the business.
Yeah, like if it was a cafe, all of the recipes. Right?
Okay.
The whole, everything that makes the business tick. Like books of procedure. How do we deal with this? What happens when this happens?
Yeah.
Most businesses have books that explain to their staff, what do you do? What's your daily procedure? Yeah, job specifications, right? All those sorts of things. If you're going to take over that business, you need that information. So it's all the books, all the records, all the manuals, all the things that shows how does this business work.
Yep.
That's what changes hands. That's what the owner has to give.
Great
Right?
example. Thank you.
Now,
All right.
I want to ask you a question.
No more.
Might be of this, but franchise.
Sorry?
Franchise.
Franchises, yes. Interesting thing, franchise.
Yeah. Does that work the same way or not? As in...
Well, yeah. So the rules of a settlement, from a conveyancing point of view, yes, everything's the same. What a franchise does is it creates an extra layer in the settlement, right? When you settle an ordinary business, you've got the vendor, you've got the purchaser, and in most cases you've got the landlord. And so you've got to get the landlord's approval for the purchaser before you can have final settlement. The landlord has the right to say, as we talked about, I don't want this purchaser in my business. They don't have enough experience, or they don't have enough money. I'm not going to give them the lease. But that's about the only time that a landlord can say no. Very rare, but they can. If in a franchise, you've now got another person who's got the right to say no. The franchisor also has to approve the purchaser. So built into the sale, you've got another condition that says it is subject to the franchisor approving the purchaser. Okay? So when you settle a house, you don't have these different people who can interfere in the sale. In the settlement of a business, you do have other people, apart from the vendor and the purchaser, who can actually interfere in the sale. And we find as brokers that one of the biggest problems will be those people, outside people, landlords, who want to mess things up. Because landlords don't like it. If I'm the landlord and you're my tenant, and you've been my tenant for 10 years and I know you, and every month you pay the rent. Suddenly, Michael comes up and says, hello, I'm a business broker. I've sold Ryan's business, and here's the new tenant, right? You don't know this person, never seen them before. You don't know how reliable they're going to be. You don't know how well they're going to run the business. You're not happy, okay? So you're going to maybe make it difficult. And exactly the same in a franchise, right? He owns Wiggly Worms franchise, right? We have garden worm farms, and we're a franchise business, right? And he's been dealing with me for years, Suddenly I'm selling it and there's another person going to come, same thing. Doesn't know me, doesn't know how well I'm going to do it. So he's not happy and he's going to try and be difficult. So when you say the rules to settle are exactly the same, but you've just introduced yet another person who might want to make it hard. Just to make life fun. Now you understand why there's so few people who sell businesses. All the other real estate guys say, it's incredibly difficult what you guys do, and it is difficult, but we enjoy it. We're suckers for punishment. Okay, where's my lady?
Oh, that's me. I'll be a lady now, right?
Well, you're my delivery lady. One for me. One for. So this is the one where there's no land involved. That's the one we're going to do. I didn't count. I hope Bill gave enough. That would be
I
funny.
think there should be. There's not too many
Well, I was just handing those out. You know how you said, like with respect to how long a person's been trading on location, if they were like Brighton for 20 years or something and they moved for the last 6 months of business to Glenelg, the business was only 6 months?
Yep.
What if their move was ever so slight? What if it was to...
You still have to tell people, but it won't make a difference. I mean, yes, if you were in a shop at Glenelg on Jetty Road,
Yeah.
and you got an opportunity to move to a bigger shop on Jetty Road that was 50 yards away,
Yeah.
you have still moved location, so you have to tell the buyer that. But does that move make any difference? None at all,
No.
right? But if you move from Glenelg to Elizabeth, yes, you've still got to tell the buyer, does that move make a difference? Well, it may have done, right? You've lost all of your customers from Glenelg and you've got to create all new customers at Elizabeth.
Yeah,
so that's why you have to tell the buyer.
Yeah, I understand that, but I'm asking you specifically when it says time at present location,
Yep.
if the move was ever so slight, like...
Next door, you'd still have to tell them.
No, is that considered a period of new location?
Yeah.
So if 2 months ago I moved to a different office, the business moved to a different office suite on the same floor of the same building, that's considered 2 months at the present location.
Correct.
Yeah.
But you could also legitimately say 10 years in this building. That's true.
Yeah, but they still have to put 2 months at the present location.
Only on the Form 2. It's the only place it appears.
Yeah.
So that would only apply if the sale was under 300. If it was over 300, you wouldn't even give a Form 2, so you wouldn't even worry about telling a buyer. You'd only tell the buyer if it was under 300 because it's in the Form 2. It's one of the questions in the Form 2. Yeah. But it's a classic example where some moves mean nothing and some moves mean an awful amount. So that's why you declare it. It's up to the purchaser to decide, does that move mean anything or nothing at all, right? If it was in the same building, it means nothing. It hasn't damaged the business in any way, shape. In fact, it might have improved it. You might have moved from a small office to a big office, right? Might make the business better, but you're still telling the buyer that you've moved from the day when you started, right?
Yeah.
All right, 8:20. Okay. This is a fairly new document, right? The Australian Institute of Conveyancers totally revamped their business contract just under 12 months ago. And this is their new document. It is definitely an improvement on the previous one and even more like the REI's one now. And you'll see right from the beginning, you just look at it, you've got the vendor, you've got the purchaser, you've got the business, you've got the property, if it's applicable, if you're selling the property. Who is the lessor? Who's the landlord? What's the details of the lease? What's the amount of the deposit? The deposit agent. In other words, who's holding the deposit? In the REI one, the deposit is always held by the broker, the agent, but it may be someone else. It could be you as the conveyancer. Could be the person holding the deposit. Could be an independent solicitor. Could be an accountant. But whoever it is nominated there. The purchase price, the estimated value of the stock, excluded assets and included assets. What's being sold with the business? The stock taker. Who's going to do the stock take? We're on item 12. Accruals is same as adjustments, right? What are you going to adjust? What's going to be dealt with at the point of settlement? Outgoings, you look here, they actually go into more detail about what may be adjusted at settlement. Outgoings under the lease. Prepayments, if the vendor has paid a year's insurance, right, and they're only 1 month into that year, so then that's a prepayment. So that will be adjusted at settlement. Date by which all the conditions must be dealt with. The completion date settlement. Time of completion actually goes into nominal. Now, I think personally, I think that's incredibly dangerous, because how can I know when I write this contract, which may be 4, 6, 8 weeks before settlement, how can I know what time settlement's going to take place on a certain day? But anyway, where is settlement going to take place? At the LTO, or is it going to take place at the conveyancer's office? Are there any licences that need to be transferred? Are there any specific contracts that the business has got that need to be transferred across with the business? Now here you'll see this is quite good. On page 7, it goes into detailing for staff what percentage of annual leave is going to be paid. It says 100%. But then it goes on to talk about what percentage of long service leave will go, and it makes an allowance. 7 years, 6 years, 5 years, even down to 4 years. In the conveyancing contract, it actually goes down to 4 years, whereas in the business one, well, it doesn't say, but it normally stops at 5 years, right? But this one actually goes down to 4 years. Again, we're dealing with restriction. 24. So if the vendor opens up business in opposition, that says how much the buyer can claim as compensation, right? We don't say that. We leave that for the court to determine. This contract actually puts a price on how much compensation a purchaser could claim. Same as how many kilometres away the business is allowed to be and how many years. Now, you'll see, you talked about the waterfall clause, and you asked what we were talking about, Julie. You'll see it says there's 2 different distances, a bigger distance and then a lesser distance in item number 14, item 25 rather. And in item 26, 3 time periods that may be applicable. I've told you my opinion. I don't agree with that, but it's there, it's in the contract, right? I think the moment the first one gets knocked out, the other 2 are automatically invalid. So I don't understand why you put more than 1. But anyway, some people do. That's fine. Costs. Traditionally, costs split 50-50 by the vendor and the purchaser, but it's spelt out in the contract in case it's going to be any different. Okay, so now I think, you may or may not know the term. Yes.
With the licences, some of those could be really expensive, couldn't they? Like a taxi plate licence.
Yep.
So would that be considered part of the...
That would be what they were selling. No, that would be the purchase price, because you sell a taxi plate, that's what you're selling.
So that's included in the 300k?
Yes.
Yeah.
So conditions precedent is simply a legal term that means subject conditions. So here, page 8 and 9 list what different special conditions there are. You'll see due diligence, finance, vendor's release of encumbrances. For FIRB, Foreign Investment Review Board. Okay, now that's very, very rarely does that apply to a business. It does often apply to property, but it's there because this is a conveyancing contract, so in case. In almost every deal you do for a business, you'd cross that out. It won't be relevant. Foreign Investment Review Board. That's if the buyer is an overseas resident and is spending more than a certain amount of over $3 million, I think it is from memory.
So what clause get to now? What item number?
Number 4 on page 8. FIRB, it says in the margin.
So if it's not applicable...
just cross through it.
So you just do a Z, or do you prefer strike out?
Oh, I don't. I think most people use a Z.
Just a Z?
Yeah. Because only Americans... No. We say Z, don't we? XYZ. Yes. Australians say Z. Americans say Z, yeah. So clause 5 is licences, if there are any. material contracts, if the vendor has a license or a contract, and that's being transferred as part of it, you would nominate it here, and then you talk about here the special condition whether or not it's going to be a lease or an assignment of a lease. Intellectual property, if there is any intellectual property. The business name is definitely intellectual property, so you would put it in item 1. If there is websites, domain names, they'd go in item 2. If there are trademarks, item 3, any other intellectual property gets listed there. So now you've got the parties on page 11. The date of the agreement, executed by the vendor, if the vendor is a company, if the vendor is an individual, or any other form down at the bottom. Then on the next page, purchaser. Page 12 is where the purchaser signs. Page 13, a list of all of the plant and equipment that is included in the transaction. Page 14, which employees, you name them, right? So exactly as we did in the real estate one, what you would probably put there is list to be supplied no later than 14 days before settlement. Because at the time the buyer is signing this contract, he hasn't yet had a chance to talk to the staff. So he can't decide. What other special conditions are going to be included in the sale on page 15? And then you've got who is the definitions. Okay, so then you've got the terms and the conditions, which is the same again, and it defines all of these and what the words mean down through page 18 and page 19. And then here we go, starting on page 20, you've actually got the terms again. And most of this is exactly the same as is in the Real Estate Institute one. It might be in slightly different order, but there's nothing here that is not there, and there's nothing there that's not here. They're both good contracts. Purchase price adjustments, the GST, going concern, which we've talked about, GST. Page 23, what have we got? There's allowable actions, talking about the offer of employment to staff. Well, you've listed who that staff are going to be. Stock take, 8.2 talks about how stock take will happen on prior to it. Vendors' obligations, the thing the vendor's got to do on page 25. Vendors' obligations regarding the employees, again, the vendor has to pay legal things that they have to do. Vendor's obligation regarding the staff that aren't going to be transferred, the vendor has to pay them out. Receivables, clause 9 on page 26. Again, book debts, where money's owing to the business. As that money comes in after settlement, the purchaser has to transfer that money to the vendor. Employees, again on number 10, the purchaser takes over the leave entitlements and superannuation and long service leave, etc., etc. Warranties that the vendor is given. Indemnity, purchaser acknowledges that they 12.6. If required, the purchaser acknowledges they've received a Form 2. We've talked about, that's actually not said there. The purchaser actually, apart from signing it when we give it to them, in this contract, the purchaser actually acknowledges that they have received it as well. Competition, so we've talked about what the vendor can and can't do. We've talked about the non-competing rights, that's there. Confidentiality, again, dealing with this, keeping this under the Privacy Act. Notices, costs, stamp duty, foreign resident capital gains withholding. You guys would know about that. If they spend more than a certain amount of money, if it's a foreign resident, they've got to hold some back. That's just covered specifically there. Clause 19, special conditions, that they can cancel a contract. And general, exactly the same. I'm sorry, I've rushed that, I understand that, but it's because we've talked a long time in detail with the first one, and if you go back through it and read it, you will see it as exactly the same in that one, right? So I don't want to waste your time saying the same thing twice, right? What I will tell you, almost certainly, I think, I don't know if you're listening, Bill, almost certainly I think you do get a question on this part of the course that relates to completing a contract for the sale of a business. I'm pretty certain you do. It's not a difficult sale. There's no sort of tricks and traps that they're deliberately trying to trick you up. If you read back over, and I can't remember whether it's on the AIC one or the REI one, but if you just look back over it, it's a pretty straightforward document, right? And both of them are. You'll be given, the names of the parties, how much money they're spending, what the business is, when settlement date. You'll get told if it's subject to finance or if it's subject to a new lease. So just filling in those conditions is not that difficult, right? I'm serious. It's not a hard, complex assignment that you will get. But recognise that I'm pretty certain you do get one on it later down in the track. So keep your notes. Keep your copies of the documents, have a look over them, and I don't think that it'll cause you any major problem. But if you do get any major problem and you just can't remember, you've always got a phone number up there that you can ring if you need to.
What, even during the assignment?
If you need help, I mean, in real...
We've got your number.
Yeah, in real life, right, if you were doing something in an office and you had a problem, what would you do? You'd walk into your boss and you say, how do I deal with this, right? So why would it be any different, right? If you're given an assignment and you're not quite sure, ring someone who knows. Ask a friend. Say, yeah, okay. I think I should do this. Is that right? What do you think? I'm not going to say no. I'll tell you whether it should or it shouldn't.
Week 9. Yes, it's week 9.
What's week 9? Did you get an assignment?
Yeah.
Okay. What are we today? Week 6.
Yeah.
So, 3 weeks' time. Okay. Well, if you do have an issue, you know where to reach me. Okay.
You all heard that?
Yeah. Does anybody have any more information that we put on tape?
Yes, I got one more.
Oh, no, we're going to. No, he's going to be rude about you, Bill. So I'm going to turn it off.